Well, good afternoon, traders. And if we look across the G10 currency spectrum at the moment, you've got cyclical forces, which have obviously been the big dominant thematic. The idea that we're seeing this economic slowdown, a lot of the leading indicators are giving us an idea that we're seeing greater economic fragility, and that will need an aggressive central bank response. Of course, you've looked at the swaps or rates curve in Australia and New Zealand, in the US, to Japan and Europe to an extent, although they're probably likely to enact on quantitative easing and asset purchases before they look at deepening their deposit rates or the more negative structure. But of course, you've seen this really aggressive rate cut expectations being priced into the different curves, and the idea that you're going to need central banks to really respond to this economic fragility. You can take Norway, which of course has been the opposite side of situations, where the market's expecting small amount of rate hikes, and you've got this kind of idea of central bank divergence playing through there. Then you've got the pound, and that's kind of what I want to touch on today, because the pound is starting to creep up into client conversations a lot more. I think it needs a bit more focus because we are coming into some of these stringent deadlines, and Brexit process has been ruled by deadline after deadline, after binary event after binary event, and of course that's what we're coming up to now. So having a little bit more understanding around this political process, and the pound really is a political currency. Political currencies are hard to trade because you are up against noise, volatility, you're up against liquidity, and you're certainly up against algorithms who can react far quicker than we can. But I think it's a good idea to know the process from this situation and what's happening in the structural positions in the market as a consideration for you as a trader. Now, we are coming up to some big deadlines. We've already seen the first leadership challenge playing through. Boris Johnson won that very, very easily. I think he got 114 out of 313 MP votes, so 37% of MPs have already given and shown their hand and their support for Boris Johnson. The bookies have got Boris Johnson as firm favourite, and we go through this week looking for more votes and those numbers to be whittled down to the final two. This will then be pushed through to a postal vote where the raft of Conservative members can have a chance to have their vote over a postal vote, as I say. And again, Boris Johnson is quite well liked amongst that wider support base. And one suspects Boris Johnson's got a fairly good chance of taking this one home. Certainly the markets have largely discounted that situation. Now, if you have a look at the pound, it has been falling quite hard for some time. People have been quite concerned about what was happening in the political process with Theresa May stepping down, and who's going to come in and what does that mean for the Brexit process. You've seen strong downtrends in sterling Swiss, sterling yen, euro sterling's been moving up and consolidating around that sort of 89 handle. We've seen cable really coming back onto its own again. That's becoming one of our more traded currencies by clients. And actually, if you have a look at positioning in the market, if you have a look at futures positioning through the Commitment of Traders report, the market is short the pound, but it's not particularly extreme. We've got negative 44,000 contracts, or the market net short 44,000 futures contract, which is a good proxy of how people are holding on the speculative side their short positions in the spot market. That's not particularly extreme. Okay, we go back a couple of months ago and we saw that with a net short position of 80,000 when cable was trading around 131. We can actually look at what's happening in the options market. And if you have a look at risk reversals, I think they give us a really good insight as well. This gives you the skew of optionality between put and call volatility. And of course, when you saw a number really deeply negative, you know that there's been big demand for put optionalities and put volatility over call volatility, which tells you that the market's very bearish and expecting downside structures, whether that's for a hedging structure or whether that's people just purely speculating. We can get a sense by these ideas of these products called risk reversals. At the moment, if we have a look at 1 month cable risk reversals, we can see them at negative 0.22. So there's a slight skew to own put volatility over call volatility. So people are expecting modest downside there. But you go back to what we saw in March, the market was holding this negative 2.77 position on risk reversals. The market was very, very bearish on pound then. So we've come back to a much more neutral setting. You can have a look at that again on what's happening in 3 month risk reversals. And again, slightly further out the curve, and you can see this idea that people are pretty neutral on where they hold the volatility in the pound. And volatility itself, if we have a look at 3 month volatility in cable, it sits at 6.99%. This is a standard deviation annualized return, or annualized expected move. And the idea with implied volatility is the higher the implied volatility, the expected dispersions from a mean. So, obviously a higher number relative to where it's been, and the idea that you're going to see these greater price moves playing through. And at 6.99% on the 3 month cable, you are seeing a situation where people have really pared back their idea that we're going to see this explosive move. I think that's personally misfounded a little bit there. In fact, if we go to the deadline for Brexit, the 31st of October, and have a look at the day after, we can see, yeah, that's 137 days away, and there's going to be some time premium in that situation. But implied volatility sits at 8.5%, which I think is incredibly low for where we are at the moment. You know, to put that into layman's terms, the market is saying from current spot prices that they expect cable to have about a 540 point move either side, up or down. Volatility, of course, is directionally agnostic in that situation. So the market is not prepared for fireworks. In fact, the market is expecting an extension, a technical extension, probably through to January, which is in line with some of the commentary that we've been seeing. Now we go through to this political process. It does look like Boris Johnson's going to get this one. The market have got this firmly as their favourite. That's largely priced in. The question, of course, is should he actually get the gig as Prime Minister? What is his first port of call? Now, the Tory party have 313 seats in the Commons. Now, if you add the DUP party to that, yeah, they're around about 2 seats shy of a majority, which doesn't give them a particularly strong hand in this situation. Boris Johnson's first job, of course, now is to galvanise the troops, create some confidence and really take them for a negotiation period with the EU. Now, the EU have said that they're not going to change their stance. Boris Johnson has said that he will use this £39 billion withdrawal agreement bill as a kind of carrot to try and create some wiggle room there, but they're not going to move on obviously what is the ultimate sticking point, and that's the Irish backstop. So one suspects what we will see is Boris Johnson play his card here and look to try and leave. That's going to create a vote of no confidence, which is pretty shaky given what we've been seeing from the Tory party and their numbers that they've got there. But there has been some members within the Tory party who've said they'll vote against the government in this situation. People like Dominic Grieve, for example, have said that they will vote against their government if they do try and take them out with a no-deal Brexit on the 31st of October. So it does look like we are facing up for a general election, which will therefore require an extension from the EU in that situation. How sterling volatility does not increase in that situation is beyond me. I think that we're going to see, the pound really come into some shaky ground. The question then is, with the Tory party probably going to be strongly voting and representing the Leave party and appealing to the masses out there in the UK to vote for them on the promise that they will leave after an adjustment period. And then you've got the Labour Party, who would have seen how well the Liberal Democrats have did in the European parliamentary elections and then position themselves firmly for the Remain Party. Where will we see in that situation? We are gunning very much for a political showdown of sorts, where it will be brought back to the people probably at the end of the year for a new general election. And in that situation, understanding how the pound trades and the dynamics that I've talked about, I think is very key. As we said, the market is pretty neutral. I think that's misplaced, and I think we're going to see volatility pick up again.